This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Rob Frost, thanks very much for coming back on Talk Your Book. You're the doyen of microcap investing in Australia, so rapt to have you back on. I thought maybe we could start by, I know you've just got nominated for a new award and you've had a huge current financial year. Maybe you could talk us through both of those items.
Just put Chris on the marketing team, obviously, but no, thanks for those kind words. So the micro-cap fund's obviously one that's near and dear to my heart, even though I run a small-cap fund as well. I find the micro-cap space particularly interesting.
And I thought we could do something a little bit differently today. I know there's a couple of stocks you want to get to at the end, which we can walk through and people can put on their watch list, but I thought it might just be good at the start to dig a little bit deeper into both what micro-cap investing is to you and a little bit about the framework you use at OC Funds Management. So maybe we could start with just defining what a micro-cap stock is, in your opinion. Interesting
question in the sense that there's no real formal definition of where a micro-cap starts and a small-cap starts and where a nano-cap. I mean, each investor has their own perception of micro. We consider it any stock with a market capitalisation of under $350 million when we make the initial investment into the company. So, anything above that, we purely look at for our small cap fund, and anything under 350 we consider micro. So, what we're trying to do is have a sensible cutoff so we don't become a small cap by default as the fund grows in size. And we want to keep the fund small and nimble. And, as you know, you need to be able to have the liquidity, be able to move in and out of these stocks. So keeping it these smaller companies makes it easier to get in and out and hopefully make good profits for your investors.
And why the attraction for micro caps?
A number of things attract me to the micros in particular. I think obviously being small, there's much greater potential for growth. They're usually earlier in their evolution as a business, so easier to grow your profit from say $5 to $20 million and from 100 to 200 million, for instance. Usually really good investor alignment in that space. So you find a lot of founder-led businesses and key management who've got material stakes in the company. So you're really aligning yourself with the guys who are running the business, which is something we really like when we're investing. Also, there tends to be less analyst coverage or less people trawling over the space. So in that sense, it can be less efficient from a pricing perspective, and really much easier to find companies that you are materially undervalued. Whereas if you went and look at BHP, it'd be hard to access the MD, and there's the whole market's looking at it. But if you go and look at some of the smaller businesses like an AMA Group or Cedar Woods Property, there's not many people covering it. And if you pick the right ones, you can make a lot of money. I mean, guys like Cochlear, Domino's, REA, even more recently, Afterpay was a micro cap when it started out, and all those companies started off in the micro cap space. And if you were smart enough to hold on to them the whole way, which I certainly haven't been, but you could have made an absolute fortune. So really good potential for capital gains if you get it right.
I remember looking at Afterpay at $1.50 at the IPO and decided it was overpriced. I'm well and truly in the same boat there. Talk to me about your investment process. I know you've got a really clearly articulated framework that you use. Can you share with me things around perhaps a checklist that you use and scoring system or weighting system, and how perhaps some everyday investors could use that for their investing process?
Yeah. Chris, I think it's important for people to understand why they're investing in a stock. So we have sort of three buckets that we invest in. So we have our core fundamental investments, which are really profitable, cash flow positive, buy hold. We've got a smaller sleeve, which we call the concept innovative businesses that have to have a pathway to profitability within 5 years. And we have some shorter term event-driven opportunities, which can be around placements and IPOs. But what we really try and focus on at OC is the core fundamental section. So these businesses have to be profitable and cash flow positive, we screen out complex, opaque businesses that we don't understand. So what that really means is trying to invest in your circle of competence, as Charlie Munger, who's Warren Buffett's business partner, calls it your circle of competence. If you understand a business and know a little bit about the industry, you're obviously going to have a better ability to value it than perhaps if I was to look at a biotech stock and have no scientific background. It's more akin to speculation. So try and invest in businesses you understand, and also for us, we have to have accessible, trustworthy management. So that's sort of our initial screen for the emerging companies, and then after that, if they pass that initial screen, we sort of have a checklist of about 6 things and 6 areas that we assess the companies and give them a score out of 100. And the higher the score, all things being equal, typically the higher the weighting we're prepared to hold them in the portfolio.
So things like management, acumen, size of the market, perhaps historical results, I'd assume they're part of the 6 things that go into that bucket. What else are you looking at to decide if something's worthwhile investment?
Yeah, so you spot on management. Management's the first thing we look at, and these categories are not mutually exclusive, because if you've got good management, you tend to have a good operating history. But we start with management because particularly in micro caps, you tend not to have the deep layers of management that you get at the bigger end of the market. So the success or otherwise of these businesses can be heavily dependent on the quality of the guys who are driving the car. So we look at who they are, what their track record is. We look at their incentivization schemes, like, we like them to be aligned with us as investors, and whether they act ethically in the interest of the companies, or whether they're, really empire builders who don't own much equity and just want to build a really big company and don't really care about generating shareholder wealth. So, yeah, management's really important. We look at the actual business model itself. Is it proven and sustainable and something we can understand? Again, coming back to if it's opaque or reliant on a few key suppliers who can pretty quickly pivot to another business, doesn't score very well. We look at things like the operating history of the business, so how long it's been going for, and the longevity and track record at growing profitability. I mean, obviously, if you've got a business that's been going for 10 years and growing its profits every year, it's better than the business that's up and down and perhaps an indication that it's a bit more cyclical. Another thing we look at is the industry structure. So what sort of industry does it operate in, and where is it an industry leader? So I guess at the moment, retail is very topical because there's been a big pivot to online. So if you're looking at a retailer, are they an old-fashioned bricks and mortar company like Myer that's structurally challenged, perhaps wouldn't score as well as someone like a Cogan or a Temple & Webster, where everyone's shopping at home, and those businesses are very well positioned going forward. We look at the company structure. So is it easy to understand? Does it have good governance? And we look at the financial track record. So things like cash conversion, whether it uses appropriate accounting policies, and things like that. And that all gets a score out of 100. And anything that scores under the threshold, we don't even do valuation work on, Chris. We consider it too risky. And, that's sort of our threshold test, those sort of categories.
How do you weigh up things like, you mentioned, say, Cogan there, who are, I guess in some ways an Australian version of Amazon, and just done brilliantly well throughout this period. They've got a huge tailwind in online shopping, which still has a way to catch up from Australia to the rest of the world. But on the other hand, that's priced in. Everyone knows that they're an industry leader for online shopping in Australia. How do you weigh up the, sometimes backing the ugly redheaded sister that perhaps is a lot cheaper than the industry leader that the whole world knows is has a huge tailwind at its back?
Yeah, and I think that more comes into it for us at the valuation level. So you have to have a certain quality of business to get through our checklist, because what we're trying to avoid is stocks where things can come from left field and just you have permanent loss of your investors' capital. So that's what I talk about when I'm talking about, say, a biotech that's going through a phase 3B trial and it misses on its primary endpoint and it goes down 80%. But I guess what you're talking about is a traditional bricks and mortar company like, I don't know, maybe a Kathmandu versus a Cogan. Kathmandu may score lower on the risk assessment, but the valuation, we overlay the risk assessment with the valuation.
Yeah.
And the valuation of Upside and Kathmandu might be trading at, say, a 50% discount to our valuation. So it will score a much higher score on the valuation part of the equation versus, say, a Cogan at the moment. We still like Cogan, but ironically or incidentally, they're raising capital today. So I think they've got an investor call on now. So maybe they think this price is overvalued too. They're filling up the coffers, or perhaps they've got a lot of opportunity. I'm not sure. I'm having a chat to them after this call. So with yourself.
And what thematics, more broadly speaking, are exciting in the market at the minute?
We're starting to look at some of the businesses that we think will perform well in the coming 12 months and perhaps have been sold down. So perhaps some of the ugly sisters that you were talking about that have really copped between the eyes. So one business is AMA Group, which is the largest panel repair shop in the country. They recently bought the Capital Smart business from Suncorp, and that business was aggressively sold down. Obviously, a lot of businesses in that space shut, and the cars are off the road, and they've got quite a high debt level. So people were concerned that they were going to have to raise capital, and now with everyone out and about and afraid to catch public transport, there's more cars out there, more people are going to have car accidents. A lot of their less capitalised competitors are going to go broke. So we're looking at businesses like that we think could really prosper in the next 12 months, but perhaps haven't quite recovered to anywhere near the levels they were pre-pandemic.
And just digging in a little deeper on AMA, I think that acquisition they bought from Suncorp is sort of key to that story. At the minute, they paid a really hefty price for it. But the revenue streams are perhaps a little bit more steady for 25 years, and in some ways they've all a cash flow. Do you maybe want to talk us through that acquisition more broadly, and perhaps a little bit around some of the renegotiations that have been taking place there as well?
Sure, absolutely, Chris. I think it was a critical acquisition in the sense that if you look at what's happening on a global basis, there's a real move from the insurers to deal with corporatised panel repair shops. So if you look at the US, it's dominated by a couple of big players, and Boyd Group's one of the most successful listed businesses in the US over the last few years. Same dynamics played out in the UK, and what the Capital Smart acquisition allowed AMA to do was to really dominate the domestic panel repair industry and make it very hard for private equity or anyone else to come in and build a big competitor to AMA, because they've got such a dominant market position. And what that means is for people like NRMA and Suncorp, they can do a deal with AMA, put all their cars through them. They don't have to deal with mum and dad panel shops and have individual deals. And obviously AMA can get much better scale advantages through paint supply and parts and economies of scale, and so it obviously works out better for the insurers because they get a better quality product at a lower price, and AMA, being the aggregator, gets big scale benefits and guaranteed volumes from the insurers. So it's sort of a win-win.
And you mentioned before that perhaps the economy more broadly is starting to get stronger and starting to reflate, if you like. I think there's been a bit of an arm wrestle between people that see a big deflation crisis coming, in which case a big pile of debt is just the most horrible thing you can possibly own. But if we do start to see inflation slowly tick up, that big pile of debt isn't quite as dangerous as it seems if you've got a deflationary crisis on the horizon. Is that something you've been taking into consideration?
Balance sheets obviously been front and centre where credit markets froze, and it's very hard for anyone to raise money in the debt markets unless you're a prime highly rated business. So that sort of ruled out most micro caps. But obviously with the opening up of the economy, there are people like AMA who are sold down heavily on the back of the need to raise capital. And with things opening up, they're going to increase their business significantly, and people not catching public transport, the likelihood of the need to do a raising's going down pretty rapidly, and we think that'll be reflected in the share price over the short to over the medium term anyway.
Yeah. And talk to me about another small cap, Viva Leisure Group, which doesn't sound like the most exciting small cap going around. It's obviously got some gym exposure. Talk me through a little bit about Viva Leisure and what you're seeing there that could prove it to be an exciting investment.
Yeah, so Viva Leisure was a gym business started in Canberra by two brothers. So Harry, the MD, sort of founded the business back in 2004. So it's 16-year heritage. I remember walking away from a briefing one day and another fund manager going, "Oh, did you hear Ord Minette's trying to float a gym business based in Canberra? Sounds awful." But that's the beauty about small caps and micro caps. You've got to look under every rock, because this is a fantastic business with great technology that's growing very rapidly, both organically and through acquisition. So, it's gone from 30 odd clubs to 100 odd. It's got about 79 open now, with 21 greenfields on the way, growing very, very rapidly. It's got some incredible tech smarts to the business, so sort of differentiate it from a lot of its peers. And if you think about gym businesses, there's not very high barriers to entry, but there's not very many exit mechanisms for owners as well. So Viva's been able to upgrade its profit about 3 times in its first year of operations. It's growing its network very quickly. So if you get that sort of dynamic, the company's trading on a much higher PE multiple than what they're able to acquire business for. So you get a PE multiple arbitrage there.
Yeah.
The greenfield sites they're operating and opening, that they get to profitability within 6 weeks to 2 months. So very strong EPS growth story, and the industry itself is really struggling. If you look at the big player, which is owned by Quadrant, which you probably know, Fitness First and Good Life, they've got a lot of debt and really not growing very quickly at the moment. So Viva's a very well-run business with good tech that's out there aggregating the industry, and we think's got a runway to grow its EPS very strongly over the next couple of years, and business we really like.
And what did the current lockdown climate do to their share price? How much did it drop?
Yeah, Charlie, it actually, what they say, one day rooster, next day feather duster, but the stock price went from $2.70 in February, after it just upgraded its profit. Went down. I think we bought some stock at 70 cents at the lows in the pandemic, because there was a lockdown and people were thinking, well, no one's ever going to go to a gym again because these social distancing issues, and they're not going to have any revenue. So they did a fantastic job of keeping their members through that period. So they put most of them on suspension, and they did a digital membership. So they sent them workouts at home, hundreds of workouts that they could do at home. And they've opening back up. They had 96,000 members pre-lockdown, and by the end of this month, and when all their gyms should be open again, I think as of about a week from now, they're going to have 90,000 members. So they've only lost about 6% of their members over that period, which is a terrific effort. And they had a big promotion over the long weekend that we just had, and signed up another 1,000 members. So really innovative business. It's growing, but it shows you that out of crisis comes opportunities. Unfortunately, there's quite a few of them that got sold down aggressively that we didn't pick up, but we did buy some more Viva Leisure over that period.
You mentioned the fact that they're a founder-led business. Do you think the founder-led businesses often get run differently to businesses that are being run by managers that perhaps don't have a lot of skin in the game?
I think there's certainly an element of that. I think there's less of an inclination to try and empire build in a founder-led business, because take Viva, where Harry and his brother Angelo, they own circa 50% of the business. What's important to them is profitable growth, EPS growth, and share price appreciation, because that's what's going to move the needle for them personally. Whereas if you've got professional management, they may not have much skin in the game, but if they can build a much bigger company by market capitalisation, so they might go out and make a whole lot of acquisitions that are not necessarily value creating or EPS accretive, but they might turn it into $1 billion company. If you're $1 billion company, you can probably convince your board to pay you a higher salary and that sort of stuff. So, founder-led businesses tend to be intimately involved in the fabric of the business. They set the culture, and because it is essentially their business. So, I think particularly in the micro cap space, it's something we really look towards.
Very good, mate. Well, 19% up this financial year. Hopefully you can hold on to that for the remaining time till the year's over, and it can be obnoxious and arrogant to all the other fund managers out there, Frosty.
Almost certain to have a couple of blowouts in the next couple of days now, Juddy. Thanks for that.
Good, mate. Thanks very much for coming on. Really appreciate it.
My pleasure. Good to chat again.
Cheers.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talk Your Book. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.